All right. Good morning, everybody. So, okay, so for those of you, if you were in the gold room yesterday, we had a couple of two solid trades in the SPX, which I documented, and then what I'm going to be doing is documenting stuff as we go. We gapped up in the morning into the 5 EMA. We got our red dots. We sold call credit spreads. We got our 40% profit. And then we actually sold put credit spreads here and we got 40% profit again. And then I went and did yoga. So I completely missed this amazing move. But that's fine. You know, I still made my daily goal. You don't have to catch every move to make your daily goal. And then so, you know, today we want to see kind of where some things are. Now, what I did here on the squeeze rotation, and I've got some updated workspaces to share with you guys, like this tick label. When it's positive, it's green. It's negative, it's red. You can see here how I add some of our other stuff, like the Squeeze Pro is here on the 30-minute chart and the RAF, and then the voodoo lines, if you guys have those. If you don't, that's fine. Just, you know, some people are asking like how I utilize that in that way, because this is really just kind of the bigger picture. And then keep in mind, as we're starting today, what I'm looking at is we are down here on the SPX at the tree line. We're at the lower 3 standard deviation band to the, you know, it's so the idea here that I look at this and just kind of like, if we were at the upper 3 standard deviation band, I'd be skeptical of the upside. And as we're hanging around here, I'm skeptical of the downside. And then in this middle one here, I'm experimenting with different backgrounds. A couple people said white is pretty good. I just changed these to candles just so we could see them a little bit better. And of course, this is the 1-minute one here. And then this is the squeeze rotation. And what we're going to be looking at, of course, in addition, is that we got the regular rotation and rotation SD. And, you know, what is the difference between those? And I'll take some screenshots of this. So the regular rotation, if you guys remember, is the faster one, kind of the MACD setting. And it, you know, they're similar. This one is just faster. And so it's, you know, a little bit different there. And then the difference between, and we'll go over this more, so don't worry. The difference between regular and then SD just stands for standard deviation. And we'll get into why, you know, why that's important in a little bit. But initially here, I just want to, you know, let's keep an eye on the open here. S&Ps here are up 8 points, not really a great move. Remember, one of the main things that we talked about in class is that there are 2 main things to kind of look at. Is that we want to see, like, either we're at kind of that 21 EMA from the 30-minute chart, and you can see we're right now we're, you know, 0.1% away, and we're looking to fade that, or, you know, like here we were 1% away or close to 1% away, and we're looking for a move back to it. So when we open up right at it, there's not a lot to do at the open because it's just, you know, we don't have anything here, but we do want to watch and kind of see how things, you know, things are doing there. Yeah, and that's a good point. You know, VIX futures here probably a little bit more responsive. So those are a few things like that I'm continuing to tweak. I'll share with you guys this tick tool. Again, it colors green when the ticks are above 0. VIX futures probably make more sense here as well. Let me throw those on there. So I'm just going to come over here. In theory, there we go. And of course, I'll get all these shared with you guys and everything too. VIX, yeah, there we go. I'll have to work on that too. Maybe we can see if it's up or down on the day. It's a little hard to see with those gray backgrounds, so let me just change those to white real quick. And usually, you know, what I found is in the morning when it opens up kind of quiet, there's not much to do initially. Yesterday we gapped up, and so if you gap up, you're immediately looking for the first sell signals in which to sell a call credit spread. If you gap down, you know, you're immediately looking for essentially rotation signals to sell a put credit spread. But when you open up kind of flat like we did this morning, there's not much to do initially in the morning, which is totally fine. Studies, edit studies. So I'm just going to make these labels white. And then I'm also going to have Eric come on a little bit later today. You know, after we're done with the morning session for trading, he can come on and also continue to, you know, if you haven't had a chance to set up your tools yet or watch the videos, obviously that's the easiest thing that you want to do. You don't if you haven't done that yet, you don't need to do it right now. But we also, you know, is Eric program these tools, is he can also kind of talk through us about some of the nuances and stuff like that. And I always like to hear what he has to say about them as well. All right. So in the morning, I always like to kind of see too. You'll see over here the kind of the key things I look at in the morning, just as indicators. So this is the dollar index. This is absolutely the most important tool to be watching right now, because essentially if the dollar makes new highs on the day, the markets are going to fall. That's how that's working. The dollar is very strong right now. If it moves lower on the day, you'll see that the stock market should rally. Bonds, you know, there's not a huge correlation there right now, but you know, bonds up means interest rates, longer term rates are down. Of course, VIX, you know, VIX up typically adds to the volatility and all that kind of fun stuff. And then on this one, these are just key stocks. I just like to know what they're doing. Tesla and Apple together make up almost 20% of the NASDAQ, and I think like 10% of the S&P 500. So, you know, you kind of want to know what they're doing on the day. But then down here, this little obscure one, TNX, this is the 10-year interest rates. In this market right now, if they're going down, that's kind of a good thing. If they're exploding higher, you know, it's kind of panic. Again, that's just kind of what's happening today. And you don't need to know this stuff, honestly. It's like if you're familiar with it, then I just want to show you kind of how I'm using it. You know, like I said, for when things are price actions kind of rotating and stuff like that, you don't really need to know why. You know, like knowing why is not critical. But the main thing for this morning is that, you know, we're just kind of opening up kind of flat. And so, you know, there's no rush. There's no hurry here. One question I'll get to is like, you know, essentially I like to do call spreads in the SPX, but what about watching ES versus SPX? So they're gonna be, the signals are gonna be the same, but the levels will be different. Okay, and so why will the levels be different? Well, the levels will be different because it's trades overnight, right? So I'm gonna put the 5-minute chart here. Let's see if we can see both of these. All right, this will be a little messy, but that's all right. Okay, so what we're looking for on this is that we're comparing the, oh, I need to actually grab a chart that's not linked. Initially in the morning, and again, I'm not looking at a lot of stocks because, and the main reason for that is simply because, let's see, 7, let's do green. I'm just relinking these. The main reason that I'm not looking at a lot of stocks is because, as we talked about on Saturday, so goes the S&P 500, so goes the stock you're looking at, right? So it really, actually analyzing stocks is kind of a waste of time to that extent. You know, obviously there's going to be exceptions to that rule, and you know, there's always going to be exceptions, but 95% of the time, if you analyze the S&P 500 and you get, like, say, buy signals on the S&P 500 and you're looking for a stock to trade, you know, to short-term trade, obviously in this case, then great, go trade that stock. And so that's why I'm not, you know, I don't spend a lot of time going like, oh my God, what's, you know, my son, he would watch Tesla because he wasn't trading SPX. He would just buy the stock. All right, so if we look at this, then it's like, okay, so here is 5-minute chart of the SPX and then a 5-minute chart of the ES. Okay, so you'll notice here that there's always going to be big differences in where the moving averages are. You can see that we are 0.35% away from the 50 EMA on the hourly chart. Over here, we're like minus 2% away. Okay, this is just the difference between the cash session, which only trades 6.5 hours, and the 24-hour session. Okay, so which one's more important? Well, the good news is that the signals on both are the same. You're gonna get basically the same signals if you're watching rotation here and SD rotation here. So that'll be the same. but the moving averages will be different. And what I've found is that after about the first half hour, the moving averages on the SPX are actually dominating the action. And then if you are trading the S&Ps overnight, of course you can see, we come down here into this zone and we hold it. But that's kind of a question people will get, and that's just part of it. That's just the difference between a 24-hour market and a cash session market. But the rules would still apply. If you're 1% away from a moving average and all that kind of stuff. The other thing that comes up too, it's like, well, geez, you've got these, there's all these moving averages here, and there's the 8, and then there's the 21, and then there's the 5, and then there's the 60, and does that get confusing? And really, the most important one I found to hone in on is this 30-minute one on the 21 EMA. So, you can just, if you're just going to watch one, and that's the one where if we start to get like 0.75% away to the downside, we could look for turns to the upside and vice versa. And the other ones are good, but again, if you just want to boil this down to the core, the core simplicity, those are some things to kind of look at that. Do the signals work in the overnight session? So I don't trade overnight. I used to trade overnight more, especially during COVID and all that, because we were all trapped at home. But the nature of them is I've watched them a couple times on the overnight session, and it's the same idea. So the short answer is yes. I'm not really doing anything overnight. It's just, I just kind of like for various reasons, but part of it's just like I hang out with my kids and wife and stuff like that. And so I just kind of try to get to bed early. But there are times when, especially when it's pretty volatile, with the signals there, the signals there are fine. All right. Yeah. So the things work on whatever you could trade. So, do they work on bonds? Yep. And the answer is yes. It's the same idea. So I default to the SPX just because of the advantages of daily expiration. And as we talked about on Saturday, the daily theta decay in the SPX options is an advantage, and it's a strategic advantage in trading. So then though, but if you trade bond futures, right? And the signals absolutely apply. So, here's a great move from 124 in 25 ticks all the way up to like through 126. And you can see we're up here at that upper Keltner channel, and same idea. So the nice thing about it is that, yeah, whatever you like to trade, the idea is the same. The main reason I'm using SPX options is 1,000% because of the theta decay, the daily expiration theta decay. If we did not have daily options, then I would be looking at S&P futures and things like that. But there's just a lot of strategic advantage. I would rather, if I had the choice of saying like, okay, you can short 10 S&P futures here, or you could sell a call credit spread of like 30 SPX. I would absolutely do the 30 SPX, and it's a larger position. But that's to kind of make up for the potential profit if the market like really falls and all that kind of fun stuff. So there is that strategic advantage. Crude oil, you can see here, we're just kind of hanging out at that 5 EMA. And then if we look here at, I want to look at the dollar. I talked about that earlier. William, yeah, I don't know what that play was yesterday. But yeah, certainly we'll be definitely doing some spreads and stuff today. So the dollar index here, you can see, is kind of rolling over. Okay, so that's good for the stock market. And this is one way, even though I'm not going to trade the dollar, the fact that I'm looking at it here, we're at these upper bands, we got all these sell signals, the fact that it's looks like it's going to roll over here, that's good for the stock market. And you don't need to know that. If you're familiar with the dollar, that's just a way to look at it. But you don't need to know all that, because you can just look at this. All right. So if we're looking at the SPX here, a couple things I'm looking at is that we do have, we're kind of back and forth, kind of choppy here on the SPX cash index. And then we want to kind of compare that to what's happening on the futures. So here's 5-minute futures over here. And we're kind of in no man's land. We're right in between the 21 and the hourly, the 21 EMA from the 30-minute chart. All right. And then here's the hourly from the 60-minute chart, and then here's the 8 from the 15-minute chart. We're right smack dab kind of at an inflection point. And when you're right here, there's not much to do. If it was later in the day, we might buy a straddle or something like that. But what we're looking for and what we're interested in are these kind of, when you get too extended one way, okay, and you start to turn, great, we can sell our put credit spreads for a move back to that level, right? So that's what we're looking at. So initially here it's just kind of quiet. SPX is at 36.45. The ticks are flat. We're just kind of sitting here hanging out at the 0 line. So initially here, not too much to do, which is fine. We can look at, just kind of some things here and how we would set this up if we, when we get a signal. And so the things I like to do here, so you'll notice here that on the SPX, we got 0 days to expiration, 1 day to expiration, 2 days to expiration. And for the most part, especially early in the session, I am looking at 0 days to expiration. So those all expire today. However, that being said, sometimes I will take things for the next day. Okay, so if I take things for the next day, typically it's like I call it a 12 noon to kind of a 12 noon kind of a trade. Oftentimes it's either an iron condor or some type of a vertical call debit spread. Just see if we get that overnight action. So that's what we just kind of looked at too. Yeah, SPX options versus ES options. So believe it or not, SPX options, so ES options are 1/2 the size of SPX. So if you do one SPX, that means you can do 2 ES options. A lot of people don't realize that the SPX is a bigger contract than the S&P futures. And we will do both, so you guys can see kind of how it sets up. All right, so we're kind of holding here. So what I'd like to see, and just because I'd like to see it doesn't mean it's going to happen, I'd like to see that we actually flush, and then we get, kind of further away from these key levels. Right now, we're just kind of hanging out here. And you'll notice here, like on the 30-minute chart, I mean, it's pretty positive. The 5 EMA, I like this. So this shows the 5 EMA and the 8. And typically, we'd look for a move back to that level 2. That's 37.06. So we'll see if anything can kind of get going there. Yeah, and if I have a choice, it's going to be the SPX, absolutely. And also remember that the ES is 15 points difference right now from the SPX. All right, yeah, let's take a look and see what's cooking here. Yeah, dollar's coming down. That's pretty positive. There's a tree line here. Let's see if we're getting some signals. So from a structural perspective, on the 30-minute chart, we do have dots and arrows. So bigger picture, this is, and I don't use this for day trading, but bigger picture, we do have buying pressure in the market. If we drill down on the 5-minute chart, we certainly have every oscillator except the hourly above 0. You see a little back and forth right here. And then on the 1-minute chart, which is kind of the heads up signal, we're kind of all over the place. Nothing too drastic here. You can see that hourly moving average here on the S&Ps is real resistance. If we come over here and we look at SPX, everything here is positive. Okay, so we're just kind of grinding it up here. So we're positive here as well. So one question here is like, okay, well, geez, if everything's positive here, why not buy it? And again, remember the trades that we want to look at here on the long side is either this is yesterday, either we're down here and we're that 0.75% or more away from the 21 EMA, we get some buy signals, we sell some put credit spreads, and then in the ensuing rally back to the 21, we capture the theta decay on those put credit spreads, and especially later in the day, that theta decay will collapse. Okay, so that's the first trade we always like to look at. The next trade is that if we are in a downtrend, and we get that trade, and then we start to get sell signals at the 21, then we're selling call credit spreads above it, and that's exactly what we did yesterday for kind of our trades. And so now we're just kind of here, and it's a little bit of hurry up and wait. We're kind of like, okay, well, are we going to go higher? Or are we going to go lower? Right now, structurally, everything's kind of pointing higher, But in terms of our setup, the setup we would want is, a move up into the 5 EMA, and then we pull back, and then we get in, because that's kind of that ride that we want to trade here. So that's kind of what we got going on. And let's see. Now, another question that'll come up is that it's like, well, geez, why not? We're at 3650. And, okay, so the expected move for today is 44 points. Why not sell the 3,600 put as a spread because of the high probability of that expiring, which I do sometimes. So, what would be the challenge here? And the challenge here is just simply going to be there's not a lot of credit, like, not enough to kind of help you meet your goals, kind of a thing. So if we look at the 3,600 and the 3,590, right? I'm just going to do this as a one lot trade so we can kind of compare apples to apples here. Yeah, and you can do SPYs as well, absolutely. Okay, so we got a 155 credit. That's actually not a bad credit, but it's $10 wide. So you just want to see that, okay, for this trade, our max profit would be $155, and to risk that, we're risking $845. Now, that being said, the probability of success is high because we're so far out of the money. But if we were to, and look, on that trade, 75% of the time, you're going to make money on that trade. Like, you don't need to follow any rules just because we're outside of the expected move. 75% of the time, you're going to make money on that trade. But then there's going to be 25% of the time, like, what happens if the market just rolls over and dies? And on top of that, it's not that much money. Like, it's a high probability of success, but not that much money. What I prefer to do would say, like, okay, and we may be getting some signals here, is just say, like, okay, I would rather kind of do closer, $10 wide here. That's a little bit closer. And what's going to happen is that the probability of it expiring worthless, is lower, but we're not going for worthless. We're just trying to get 40% of the credit received. And so if we look at this, you can see, like, okay, now, in this case, we're closer to the money, so it's a little bit better. We're risking 635 to make 365. But of course, remember, the only way you're going to lose 635 is if you freeze and you take no action. And if that, that makes sense. So you always want to be careful. A lot of times people see these risk to reward ratios and are like, oh, I don't want to do that. That's only if you freeze and you do nothing. So that's kind of like the, and then finally what I like to do is, let's say we do get some buy signals here, is I like to go slightly in the money. So we're at 36.55, right? So I would say, okay, geez, if it looks like we're going to do something here, I want to go slightly in the money, go 36.60, 36.60, 36.50, and now all of a sudden we have almost a 1-to-1 risk reward ratio. And so that's kind of what I'm looking for on these. So now, I'm risking 525 to make 475. And then remember, my default is that in this case, if the credit is 450, okay, what's my default target? Anybody know? So if I get a credit for 450, what's my default target? Yeah, 270. So you multiply this by 0.6. Okay, and that gives you a target of 40% of the net credit, which would be 270. Now, here's the thing that comes up with this is it's easy to say, like, well, geez, that's not that exciting. It would be better if I sold this at 450 and it went to zero. Yes, it would. However, the idea with this and the point of it is that we're not in any way, shape, or form ever trying to have something that goes worthless. All right, that's a mind screw right there. Because if you're like, oh, I'm going to sell the spread and I want it to go worthless, then you're not trading anymore. You're trying to prove that you're right. All right, and that's a mind screw. So what we want to do is we want to get in at 450, get out at 40% of the max credit available. And how that happens is we have to go, in this case, since we sold a put credit spread, we need to go sideways to higher. If we go higher quickly, this target will get hit quickly. If we go kind of higher medium way, then this will take a little bit longer. But the beauty of this is if it goes sideways, it could still hit our target. And last but not least, if for some reason it, say it pukes 20 points against us, this 450 credit might jump up to 575, right? So if you're long the S&P futures in this situation and it falls 20 points, you are absolutely getting stopped out. But if it falls 20 points and you've got a spread in the first 2 hours of the day, you're going to lose about $1.25. Okay, so that's the beauty of this is that you're able to hold through kind of the algo shenanigans, which is great. Okay, so things are looking, dollars going lower, things are looking, pretty good here. We're just kind of hanging out here. I love that 3650 level. Let's see if we could get a little bit of a smidge pullback closer. We're now kind of far enough away where we might be able to buy the next, set up a trade here against the next pullback. But things look pretty bullish here. Yeah, okay, look at this. We're starting to get arrows all over the place. We're starting to push through here. All right, let me get a put credit spread going here. Again, we're at 3660 SPX, so I want to go slightly in the money, 3665. No. And then sometimes, you kind of scramble. So it's your choice. You can do $5 wide, $10 wide. I do it based on account size. This account's like 50K. So 50K is like one contract. $10 wide, one contract per 10K. So 5 contracts, 3665, 3655 for 470 credit. Let me see if I can get that. So $10 wide on SPX is $1 wide on SPY. So SPY is 1/10 the size. All right, filled. Okay, now I just got to find okay, where's the room? Credit spread here on SPX. All right, so now we can see, and so our target on this, initial target is 40% of the credit received. So 4.55 times 0.6 equals 273. We can round that down to 273. Okay, so initially our credit is 455. You might get a little bit better credit than I did. 40% of that would be 455 times 0.6, which is 273. You can round that up or down a nickel, however you want to do that. I'm just going to put 270. All right, there we go. If you can't do spreads, would you do calls? You can, but it's absolutely a different trade. So just so you know, I mean, part of the reason I do spreads is because it is much easier to manage. With calls, you're going to have to set up a tighter stop and all that kind of fun stuff. But I certainly would encourage being able to get enabled for spreads. No, so I post one contract. I do that because everybody is responsible for choosing their own position size. So just because I'm doing 5 contracts, if you've got $1,000 account, it would be absolutely inappropriate for you to do 5 contracts. All right, so we're just kind of hanging out here. So now that we're in the trade, the idea is, are we, is this thing going to move? Is this thing going to do anything here? And remember, the nice thing about the option spread is that you don't necessarily, it doesn't have to move in your favor to make money. But we do want to know that it's at least going to hold. You can see here the ticks are green and all that kind of stuff, which is good. But the idea here is that the charts also kind of tell us, are we on the right side of this? Did we make the right decision? And that's one of the things that I learned from watching James, is that's a question that he would have. Did I make the right decision here? And so the idea with the charts here is, hold on, I'm just selling some in my large account here. The idea with the charts here is to kind of give us a visual, are we on the right side of this trade? And so, if we started seeing like red dots and down arrows, that's going to give us a heads up that's like, oh, geez, maybe we're not on the right side of this trade right now. All right, 36.75. All right, I'm just making sure I'm getting these filled here. All right, so it's a quiet morning, right? So it's a quiet morning. The ticks are just kind of hanging out here. And as I'm looking at this, it's like, okay, well, we've got buy signals here on the 30-minute chart. Resistance is that 5 EMA at 36.92. Okay, so that's 30 some odd points away. So there's certainly an opening there. We're kind of jammed here at the 21 EMA. It is a force to be reckoned with. And again, this is nice because if we're selling a spread and it's quiet, that's fine because the theta decay works in our favor. Whereas if we bought a call, we'd be getting eaten alive here. If I was, somebody asked, what about buying a call? If you are going to buy a call, and this is really, really, really important, do not buy 0 day to expiration calls. Why? Because the theta decay is so hard. So if you're doing a call, you want to actually give it a little bit more time, and that's important. So you might buy if you're buying spider calls, you might buy Friday expiration. You get a couple of days, and then that way your theta decay is not going off of a cliff. But it is important to understand if you're newer to options. While I'm in fact loving the idea of selling 0 day to expiration calls, I am in absolutely no way buying 0 days to expiration calls. So hopefully that makes sense. Yeah, the 5-minute squeeze. Yeah, so Debs, if you are looking to just okay, so good question. What if you just want to trade a stock? Yeah, absolutely. Just do SPY here. Yeah, you can absolutely do that. In fact, let's throw that on. So if you are, let me throw in some SPY trades here so you guys can see what that would look like. So if you're going to do SPY, just buy the shares. Absolutely is fine. I'll just do 100 shares. In theory. All right, so 100 shares, right? So you just buy it. And then if you were going to buy a call, and like I said, buying short-term calls is not, it's strategically, you're not giving yourself an edge. But we could go like, say, 5 days out if you're going to buy a call, and there'll be a little pricier, but you're not going to have to deal with that same theta decay. And of course, one SPY call is like having 100 shares. So on this, I would actually go slightly in the money. So here's like the 360s, and that's what I would do there. So that's an important, and by the way, and here's how I do this, is that in the first hour and a half or so, the idea is that, because this is how I learned how to trade, is I just watch somebody trade. And so part of this is just being able to replicate that. as much as possible, where, you know, for the first hour and a half or two, you just kind of, I'm talking through what I'm doing, you're watching me trade. And then we pause and document it and do kind of a post-mortem, so then you can understand everything. Okay. If you can't trade options, you can just buy SPY ETF. And if you are going to buy calls, make sure you go a few days out. While I love 0 DTE SPX options for selling spreads, I do not buy straight out calls or puts with 0 DTE, most part due to the rapid premium decay. Okay, so let me post these. So I'll just post these on here too, so you can kind of see what those are. And then remember, if you are trading it directionally, you know, it's going to be harder to hold on to and all that kind of stuff, because it's going to be more impacted by the price, whereas a spread will be able to hold on to it a little bit better. Now, here's the harder thing about directional stuff. You know, what do you use for an exit? Because we can't have premium decay. So for an exit, it would be more sell signals. You know, that's, so I think directionally is harder, frankly. The easiest directional trades would absolutely be, you know, we're below the key moving averages and then we just roll back up to it. And that's probably, you know, that's probably the easier directional trade there. But, you know, as we talked about on Saturday, you know, the edge here to me is those 0 days to expiration spreads. All right, let's see how we hang out here. We did get a little bit of a, you can see here, a little bit of a, we're just kind of hanging out here. Very quiet morning. Yeah, so it does, so the same idea for ES options as well. Now, just remember, if you're doing ES options, then, you know, the one thing also is going to be that the price is different. So you can see how the SPX is 36.56. The ES is 36.70. So they're like 15 points difference. And it's just a function of, you know, we recently had rollover, and as the ES futures get close to expiration, that and the SPX will get closer together. But it is important to understand that they don't trade at the same price. They move the same, but they're not trading at the same price. We got Powell speaking in 10 minutes. All right, so that should add a little bit of interestingness. Yeah, so as we talked about in the Saturday class, a stop loss is when you get exit signals in the complete opposite direction. Let's see, we're getting some volatility here. And again, we're just kind of hanging out here. We're not doing too much. Yeah, so when I say 0.75, the main one I'm looking at is the white one right here. So 0.75 away from that 30-minute moving average on the 21-minute chart. That's kind of the key one. And also, you know, same thing could be said here. So, you know, if you're just keying in on one, that's the one to key in on. And you can see right now, so we talked about, so now look, this is a great example here. So the 1 minute, you're going to get buys and sells all the time. The 1 minute is the heads up chart. It's like, oh, we're getting some arrow here and we've got some arrows over here. Let's get in. If you get red arrow, so right now we're long, right? We've got put credit spreads. And if you get red arrows on the 1 minute chart, that's fine. That does not, all that mean, remember, the 1 minute's fast. We don't trade off of it. It's our kind of, it's our heads up for the 5 minute. If we come over here and we look at the 5 minute, And then it's kind of like, well, yeah, we kind of popped up, we came down. It's just kind of neutral here. There's no sell arrows or anything like that. And so that's what I mean by visually just getting kind of comfortable, like, okay, are we on the right side of this trade or not? And if this thing is going to die, if this thing's going to roll over and die, then this is what we're going to see. So in the meantime, we're just kind of, hanging out here. And a lot of trading is waiting. You're just kind of like, all right, let's, what's going to happen here, and all that kind of fun stuff. Yeah, well, remember too, we're looking at this as, what do we have on the 30-minute chart? We've got buy zones here. We've got resistance at 36.90. So we are 1% away from that 5 EMA on the daily. So what we're looking for here is, are we going to be able to get some back and forth where we get a move up into that zone? And right now we're just kind of chopping, if we could get this 8 to cross the 21, that certainly would be a plus. And right now we're just kind of chopping back and forth between a 15 and a 20-point range, which is pretty normal. So good question. Would you get out before an event like Powell speaking? So that's always the tricky part, because the nice thing with spreads is that you can withstand moves. So yeah, we're coming down here. We're not getting any sells yet on the 5-minute chart. But with a spread, you can withstand moves like this directionally. Let's say if you chase the S&Ps at 36.70 and put a 20-point stop in, you're done. You just lost $1,000 per contract. On the spread, 20-point move against you is like $1.25, because the spread obviously adjusts downward as well. Right now, we're just sitting here kind of in it's not no man's land. We're just waiting, like, okay, well, we're hanging out here between the 8 and the 21 EMAs and all that kind of fun stuff. And then if we and you can see I've been playing around with different colors and like candlesticks, can we see it a little better? And that 60 EMA on the hourly certainly is kind of coming in there. Just kind of some quiet back and forth action here. So on a spread, what's great about the spreads is that when, because there are times like this when the market is in kind of a decision point mode, like, okay, what's happening here? And the spreads, they're much easier to hold on to. Like I said, if we had chased the market here and bought the S&Ps at 36.70, it would be stopped out. But instead, we're just kind of sitting here with a spread. And if this thing is going to get uglier and get some sells. All right, so we're just kind of hanging out here. Ticks coming down. We're kind of at the bottom of the range. Dollar index has popped up a smidge. Yeah, we're starting to get a little bit of rollover here, but nothing serious on price action. Definitely kind of a all over the place morning. Yeah, so you can see here we're starting now to see some red arrows here. Starting to see some red arrows. Now, is it time to kind of bail out of this trade? And again, the nice thing about the spread is it'll kind of give it a little bit. I typically, as long as we're above this 21, I'll give it a little bit of room here. But we're at that point now where it's like, okay, now, first of all, directionally, again, if we had bought the S&Ps directionally here, and now we're down here, then absolutely, it's like, okay, time to get out. With the spread, you can get a little bit more room, but this basically is not what you want to see. So a spread, you kind of have you can kind of gracefully exit. See if we get a little bit of a bounce here, and we can look to kind of exit and see if what Powell's going to say. But what's nice about this is when the trades are kind of, when they're working, what I found is that the trades that work the best are kind of, they're kind of guiding you along the way. So yesterday we did the short here, we kind of rallied up, we got the sell signals, and, or whatever day this was, it was boom. It was pretty easy. And then when you get far away from the 21, it's like, okay, great, we get the buy signals, let's sell put credits red, boom. And that's that's kind of the perfect scenario for this. And so this morning, we're just kind of like, all right, we're just kind of opening up. We're, a little bit of hurry up and wait mode. We're kind of chopping around. S&Ps are at, they're up 2 points on the day. There's a little bit of selling pressure here, but not a lot. And so that's where the advantages of spreads come in, because it's kind of easier to hold on to a spread through that kind of stuff. Zoom in on here. And then if we look at the SPX here, you can see it's, now they're kind of starting to line up a little bit more. Once you get about 30 45 minutes into the cash session, you'll see a little bit, not exactly, but the SPX you can see is a little bit below its 21 EMA, and then the ES is a little bit above. And as we get about usually about an hour or so into the day, they'll start to become more in alignment. Yeah, market's definitely in hurry up and wait mode here. All right, so we're starting to get some more red arrows here. So if we come over here and we look at our spread, it's like, all right, what do we, now it's like, okay, this is real trading. What do we do here? And you'll notice here that, the S&Ps have dropped about, 10 points from where we got in, and our spread is down about 90 cents. So that's what I mean, where the spreads don't actually move very much when it goes against you. So it kind of gives you that extra minute where it's like, all right, are things, is this just some back and forth? Because the market's not moving, it's just some back and forth. We're stuck in between those moving averages. It's like yawn, yawn, yawn. Yeah, very slow morning so far. So our spread. So again, just the advantage here. The spread is, if it goes goes against you, it doesn't move very much against you, which is kind of a nice bonus. So now we can kind of watch and just say like, yeah, okay, look, the S&Ps, they are not able to get through the 50-period moving average from the hourly chart. They've tested it 1, 2, 3, like multiple times here, and they can't get through. However, at the same time, they're also not pushing through the 21 EMA to the downside. So that's kind of my, support level there. So what I'm looking for with this, so again, just to emphasize this, directionally, if we had bought here, we'd already be out. With the spread, we haven't had to take much heat. And we are just kind of flopping around here. It's like a wet carp. All right, let me see what the dollar's doing here. It's kind of the big yawn this morning so far. Yeah, it's kind of a little bit of hurry up and wait here. So yeah, so this is kind of interesting. So, we've got a situation here where it's like 30-minute chart is bullish. You got, the squeeze, you got the arrows, you got the bars. So on the 30-minute chart, the direction is higher. On the 1 and the 5-minute chart, we're trapped in between the 60-period moving average, the 50-period moving average on the hourly chart, and then the 21-period moving average from the 30-minute chart. And so oftentimes I've noticed that when this happens, you kind of get some consolidation. And you can see it more clearly here on the 1 minute chart. So we're not able to get through. So on something like this, if if for some reason we can take out that high, we'll probably get a pretty good short covering rally. But as we're watching this too, it's like, okay, yeah, we got the one arrow here, but we're not taking out support, okay? And of course, with Powell about to speak, the markets are, not surprisingly, just kind of pausing here, but it is kind of it's a good way to watch this live just to see how it unfolds. So it's like, okay, 30-minute chart, we've got the buy signals here. Target would be 3705, which is the 5 EMA, the daily 5 EMA. That's kind of an overhead target for today. You can see obviously when there's sell signals on this, then we want to obviously then focused on that downside Kellner channel. The 5-minute chart here, we're just absolutely trapped between these two key moving averages, and then on the 1 minute, of course, that's just kind of a drill down of the 5 minutes. So certainly a lot of hurry up and wait here. And again, the advantages of a spread here is it makes waiting not that hard. And where so again, and we'll document all this directionally. This is a trade where it's like, man, if we bought it here, we'd be stopped out. For the spread, as long as we're trading above the 21 here, we're just kind of like, okay, it's a little bit of back and forth, and we're watching the oscillators here. We're just kind of we're kind of chilling out here. We're starting to hook up here on the 1 minute chart, and then of course the market's just kind of in hurry up and wait mode. Ticks here are slightly positive, nothing, nothing too great. One thing you'll notice about the markets too is that, in an environment that we're in right now, the markets should be going down. Why should they be going down? Because the news is bad everywhere. And so on some days we did see a day last week where the S&Ps were down like 100 points. And so on any day where, the news is horrible and the credit markets are freezing up and all that kind of stuff, and the market's holding on, we're up 7 points. Just keep in mind that the longer that happens, typically the greater the chance of short covering. And again, the nice thing is you don't need to know that, structurally here, it's like we're not falling apart, right? With the 21 EMA from the 30-minute chart is continuing to rise, and we're just kind of hanging out here. Yeah, now remember the charts that I've set up here are kind of the default with the tools. If you would rather use Hakanashi, over here I've got the 10x bars. So absolutely. The most important thing here is, in my opinion, first of all, is just kind of okay, let's look and see where these oscillators, what are they doing? And I'm looking at both, I got these over here too. So how are the oscillators doing? That's kind of the main idea with this is, are they turning up? Are they turning down? And then from there, what are the tools that are additive to that? Okay. And so you can see here that on the 5-minute chart on the standard deviation, SD rotation SD, which is standard deviation. And the reason we have this is that you can get to -1, -2 deviations on this, whereas on the regular, let me find the regular. On the regular, you actually get the actual. So you can see like -20, -40 on the 5-minute chart, but then over here it's like -10. Because it's showing the actual readings. And so that makes it more difficult to figure out what levels to add on here for the dots, because the dots say, yeah, anytime it goes below -10, give me the dots. Well, on this chart, -20 might be more appropriate. So the standard deviation one, you'll see it structures it more based on actual standard deviations. So it's a little, I think it's a little cleaner for as you're trying to watch this unfold. And you can see on the 5-minute chart, we haven't had any sell signals, right? We haven't had any crosses or anything like that. The 1-minute chart, of course, is all over the place, as it should be. As you're going, I still like sometimes if you can catch a really good move, yeah, this thing will just rocket higher. But the 5-minute has not given us any reason to question our trade at this point. We got our arrows in, we got the spread. Yeah, it's not, we're not doing anything, but we're not getting any sell signals either. If you look at, the rotation, we're absolutely getting sell signals. So that's just, you can see the differences between, the rotation settings versus like the standard deviation one, which is, it's a little bit more, it's, I don't know if the right term is like precise or maybe a little bit more smoothing, so you're not getting so caught up in the, this is a chop fest right here, right? All right, so let's see if we can get anything going here. And then obviously, my exit order has not been filled yet. And so one question that'll come up too, and by the way, I know as I'm going through this, we'll be, we're going to step back, we're going to take screenshots and all that kind of fun stuff. Actually, let me start taking a few screenshots here because this is stuff that we can come back to. So I want to take a screenshot here of rotation versus reg. And then versus SD. Now, if you were in the gold room yesterday, the trades we did are pretty easy. Like, it was textbook. And believe me, the textbook trades are always great because it's literally, as textbook. And we're going to go over the trades that we did yesterday in the room. Today's trade has been less clean, but it's good because you want to be able to see what to, kind of like what's important in these situations. And the main thing I want to tell you here is that, the 1 minute chart is the heads up. It's like, oh, geez, over here on the 5 minute, we're starting to rally. On the 1 minute, we got all these arrows. Awesome. Let me set up a put credit spread. But I'm not going to then exit because one of the 1 minute oscillators rolled over. So it's really just kind of a heads up. You don't have to look at it if you don't want to. I'm also going to show you what my oldest looked at. He didn't really like this. To him, didn't do much either, and so he would just look at the arrows, and so I'll set up that too, and it was pretty clean. I personally need more information, but basically what he would look at would be, here's a 5 minute chart, you got the 21 EMA, and you just had the arrows, and so he didn't look at the 1 minute at all. He thought that was a little confusing. So as we kind of go through this, and then we'll document it, and then you can kind of see, what works best for you as well. But the main point of all this, and the reason all this was created, is that, first of all, it's like, okay, do I have buy signals or sell signals? Well, in this case, we had buy signals. What am I going to do? I'm going to sell a put credit spread. We also bought a call, and a few days out, so we don't get killed by theta decay, and we bought some SPY, right? And then what do we do? How do we know when we're wrong? Well, in this case, it's when you start, especially if you start taking out prior levels and you see some down arrows here on the 5 minute chart, and then it's like, well, geez, we did see some down arrows here, and what do we look at? So that's all the stuff that we want to document today. And I will say, I'm actually glad this trade, the way, this is the first trade of the day, because this is kind of a choppy trade. It's a little bit all over the place. And guess what? That happens. The market's going to do whatever it wants. It doesn't care what we want. But what's great is that yesterday we had two back-to-back textbook trades. And so I want to document, as we put together kind of our trading manual, is a variety of situations. And so we'll document, and some of you I know already participated in the trades we did yesterday in the gold room, but we'll document those as well. And look, don't get me wrong, I like it when the trades are textbook. It's like, oh, it's easy, but they're not always going to be textbook. And so this is great just to kind of get a feel of like, okay, well, what do we do then, if it's not textbook? And that's why essentially these charts were created, is to be a guideline in that situation. So now we're just kind of sitting here. Remember, we sold the slightly in the money 36.65, 36.55. So we're kind of now at the money. The one good thing here is that when you do get to at the money, okay, that's when your theta decay starts to kick in the most. So that's kind of the key, kind of a key piece of this is like, all right, we sold it at the money. We sold it in the money. Then when we get at the money, that's when the premium decay starts to happen the fastest, okay? And so it is nice when it can at least stay above that sold strike. Okay. But by selling it in the money, my dog is barking over there. I don't know what he's barking at. By selling it in the money, the main thing there is that when it goes against us, and it went against us initially there, we were only down like 90 cents. It goes down 10 points and we're down 90 cents. And that's why the spreads are so forgiving there. So now you can see we're at 36.71, right? And look, now the premium decay is starting to happen fairly quickly. Yeah, maybe he's barking so that the S&Ps will go up. Buddy, what are you barking at? He's like, I'm helping, Dad, I'm helping. So one tough thing here too is sometimes depending on how your charts are set up, like we could get a strong rally and price just disappears. Like it could go behind the labels here, which is frankly very annoying. So how I've gotten around that, and this is already default if you've got the shared charts, is that on the price axis, yeah, that's why I have the 10% up and 10% down. So that way, you don't have, otherwise, if you don't do that, price could actually go behind the labels and you can't see it, which drives me insane. Like I've got to see where it is right now. If for some reason this pushes into the labels, I'll have to adjust it again. All right, we're starting to hang out here. Now, again, and main thing here, and this is actually a really good first trade today. It's good when it's not easy, because when it's easy, we all get complacent. It's like, oh, this is going to be easy every time. It's not. The market doesn't care. Just because you caught that last wave nice, the next wave could throw you on your ass. So we're just kind of like, all right, we got to kind of sit through that. And then, the question is like, okay, do we continue to hold on here? Because at some point, in the beginning, as we're kind of waiting for it to unfold, it's different because it's like, well, we're in. We don't want to, we got to give it a little bit of time to work out. But then at some point, we actually start getting a profit. Okay. So right now, we do have a gain. And so now it gets, it's like, oh, okay, geez, our gain is we got an exit that we're working at 270. But a couple of things to keep in mind here. Okay. First, now we're 10 points above. Okay, we're 10 points above our sold strike. And now you can see like, well, we sold it at 455 and geez, we've actually rallied 15 points, but we've only got $1.20 of profit, right? Okay, so that kind of seems lame, and I thought so too at first. But the first thing to keep in mind is, remember, when it was 15 points against us, we only had $1 loss. Had we bought the S&Ps 15 points against us, most of us would have been stopped out. So that's the first thing. Secondly, is that instead of doing, say, one S&P futures, I'm going to do 5 SPX contracts, so that if I did capture, say, 20 points on that one S&P futures contract, which if I'm doing my math right, that would be $1,000. I'm structuring it so that I could actually make that much or more simply by capturing a 40% of the premium received trade on a spread. So that's kind of the secret sauce here, is that I'm trading bigger spreads than I would directionally. Okay, I'm trading a bigger spread than I would do a directional futures contract or a directional call. And even though the bigger position you think might be dangerous because it's a spread, when it goes against you, it doesn't, 20 points against you, it's only going to move $1.25. But then when it starts to go in your favor, the beauty of it is when you sell it in the money and it goes against you, because you sold it in the money, there's not a lot for it to do. Because if it's falling, remember the 36.55 puts also gaining in value. So the downside is kind of skewed protection that way. And then on the upside, once you get above 36.65, it actually works faster in your favor. So the crazy thing here with this is that, if it's not working, it's actually working in your favor because your protected put is also increasing in value at a rate just as fast as this one that's losing value. And then secondly, and more importantly, when it does go, essentially above your sold strike, the theta decay actually works faster in your favor. So when it's going against you, it works in your favor initially. And I say initially, and I'm talking like 11 o'clock a.m. Central and before, because after that, the theta decay is very quick. It's less forgiving in the afternoon. The first couple trades of the day are absolutely going to be more forgiving. Okay, let me see here. Nice action here. We're just hanging out. Let's come over here and again look at the charts. So again, no sell signals here, right? Of course, they're all now on the 1 minute chart. You can see that you got the turn, and the turn was easy to see, but nothing happened over here. So the 1 minute, again, it's going to be all over the place. I'm kind of like in this. I'm kind of digging this lighter background in the candles too. So that might be a new. Now on the S&Ps, do note that we are finally through that 60. Okay. And then I don't expect us to push through this 5 EMA. All right. And we're 20 points away from that. Now, at this point, we do have theta decay working in our favor. Remember, as long as we're above 36.65 and we're even just consolidating, we're getting some, we're getting some money in our pocket there. And I've got, of course, multiple screens here, so trying to find the best way to share everything. But now this is the part two where it's like, okay, it's easy to get worried. Like, okay, we're getting close to our target. We're not there. I don't want to give up my profits. So what do? So this is where we do start to look for signs that the trade is over. Okay, we're starting to see red dots here. That's a kind of a sign like, oh, well, geez, hey, Ed, looking like your trade's over there. So now notice it'll appear and disappear. Okay, now that was something that we talked about because it's appearing in real time. You're getting a real-time roll. But what's important is, do you have that roll by the time that this 5 minute bar is closed? Okay, so if I see a dot like that happening, intra-bar, I'm like, okay, that's a heads up, but is it going to be there when we close? Okay, so, and again, the beauty of a spread is you don't have to like, I don't have to hustle. You have time, because while we're trading here 10 points above our sold strike, we're still making money. We're still making money. All right, let's see where we are here. $3, so we're getting close. Now at this point, this is the kind of the tricky part, because we don't want, absolutely it would be a trading sin to allow our profitable trade. Now, could it turn into a loss? Yes. Something may happen and the S&Ps drop 30 points really quickly, and we can't avoid that, right? And that happens. However, the idea that it rolls over and we sell off steadily the rest of the day and we take no action and we go to max loss, that is psychologically an issue. Okay, so we do want to get clear on when do we get out. So if our target isn't hit at 270, when do we get out? Right, and so that's kind of what we're watching here. And this is the part where it's like, okay, we're okay here. We got some dots, but they're going away. We're just kind of hanging. And sometimes, like psychologically, this is the hardest part for people to hold on to, which I get. And that's part of why we chose that 40% of the credit received instead of 60. Okay. And normally, if you've seen me do spreads like in the room, I'm like, yeah, 80% of max profit. And the idea with that is you kind of need to hold it almost into expiration to get that. Okay. Well, guess what? That's not what we want here. 40% happens quickly. If we wanted to, on this particular trade, if we wanted to get 80% of max profit, the trade, the S&Ps would need to rally another 50 points, or we'd have to hold on till almost to the end of the day. Okay. That's not what we're trying to do here. We're trying to pick up the easy money that's lying on the floor. We just want that easy cash. And trading's weird because you never know what's going to happen next. So how do you maintain confidence that you're on the right side of a trade when you don't have any idea what's going to happen next? Okay, and so that's the point of these tools, is to kind of give you confidence. It's like, okay, am I on the right side of this trade? Is there anything I am missing here? And that's the whole point of this. And that's what I really just learned from watching James too, is when he had that confidence of like, yeah, I don't, I'm not worried about this, at this moment in time. All right. There we go. Nice little pop. Now we should be getting close to our target. And again, directionally, if we had bought 100 S&P futures here, that'd have been great. I think our target is what, 270. We're okay. We should be getting it hit here. Hamada, 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 dum, 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 dum. Let me see if I can get a screenshot before it's filled. I don't want to be. You don't want to get cocky. Didn't want to get cocky. Okay, boom. Just got filled. And yeah, $925 on, so on 5 contracts, right? So then on my larger account, I need to close this out as well. So I'll show you my larger account is, let me get a screenshot of that. So in the larger account, I'm doing obviously more contracts, but also wider spreads. And so I did some like at the money and in the money put credit spreads, and I need to close these out. And remember, this is a $6 million account, and I just make the money and then I wire it out. And this, it's up $233,000 right now. So I did kind of an at the money spread, slightly out of the money spread, and then an in the money spread. And so let me work on getting those closed. Let's see, 300, 200, 200. And then we'll see what sets up next. We'll see what sets up next here. And then let me just close these other trades. All right, what am I doing here? I'm working the 3675, so I need to work. Sometimes in Tasty, it's harder to find the positions that you're in. Okay, 460. Yeah, so now we're just kind of hanging out. And so let me exit my trades here on Tasty, and then we'll do a post-mortem, and then we'll see if there's another trade here first, then we can do a potential post-mortem. And then just talk about some other ideas as well. All right, so I got that. And nice. Okay, so I hear there's a lot of questions. I have not seen them because obviously I'm looking at the screens here. So let's what time? Oh, it's already 9:42. It's probably a good chance for a break. But let me get that. Let me. Oh, you know what? Crap. We also got these trades too, right? So part of why I like just doing the SPX2 is you can just focus. So if you guys remember, we also have the spiders and spider calls, right? Which I kind of forgot about. However, you can see that we got that. Take a screenshot of those. Now, technically, we don't have an exit signal. So here's the tricky thing, I think, as well, is that for the directional stuff, we don't have an exit signal, okay? But we're already out of our spread. That's why I love doing the spreads. So the directional trade here, we could kind of keep holding on to. Me personally, I don't like to get confused. So that's why I would rather, me personally, do like, you know what? Instead of doing long futures, I'm going to buy the spiders, ETFs, I'm going to buy spider calls, I'm going to sell a spread. I would rather just pick one. And so that's what I would encourage you to do too. If you can't do spreads, that's fine. You're going to hold on to the call option and you can hold on to it. You can have a predetermined profit if you want. It's just different because the 40% credit received, you can get that without a specific amount of movement. Okay. You could also hold on to it till you get dots on the 1 minute chart, but that you're going to get a lot of dots. So what I would do when I'm doing directional stuff, what I do is just say like, okay, let's say I buy something here, then I would just stay in until I see dots on the 5 minute, indicating that we are starting to roll over on the 5 minute chart. Okay. But for now, I do want to close out these trades because, we've got, we want to stay focused on these setups. But anyway, that gives you some ideas of how this can work. Let's see, 981. And then you can see here, now we bought these late, okay? We didn't, well, no, I guess it's not, that's actually not that bad. So it's been up like 15 points. But anyway, hopefully it gives you an idea of how to do it that way too. And of course, you could have done S&Ps, you could have done options on the S&Ps, kind of, once you understand the setups, there's different ways to play it, but hopefully you understand why I do spreads on the SPX.